Hello, this is Susan Hayes, the Positive Economist, and this is the third of a series of videos called investinginyouth.com, Introducing Wall Street to the Classroom. Today I'm going to discuss the idea of comparing a stock on sale to the special offers that we see every day. For example, what type of sales do we see? Buy one get one free, buy 3 products get the third free, triple points this weekend only. But what's our favourite? Well, we love to see a percentage off, so we know we're securing a bargain. 20%, 50%, 70% off. That's what we love to see. But what exactly is a sale? Well, let's take the example of a Ferrari that I might have spent $1 million on last month, and this month all I need to do is spend 900,000 for the same car. Let's take the idea of a River Island dress. I might have paid €100 for this dress last month, but this month I would only need to pay €80 for the same dress. And similarly, for a piece of steak, I might have paid €40 last month, and this month I would pay €20 for the very same piece of meat. So why do things go on sale? Well, let's think about that. Maybe a new model of car is coming out. Maybe the dress is last season's fashion. Maybe the piece of meat is coming up to its sell-by date. In economic terms, maybe there's too little demand. Maybe there's too much supply. Or in business terms, maybe you're using a loss leader to bring in customers, happy to take a loss on some products in order to generate a gain and more sales on other products. Does the same rationale apply to stocks? Well, of course it does, but in a slightly different way. Let's take Vodafone. Would you prefer to buy it at $195 or prefer to buy it at $104? Well, of course, when the stock was on sale. Similarly with Kingspan. Would you prefer to buy it at $17.26 or at $203? Again, of course, when it's on sale. And similarly with Intel, you would much prefer to buy it at $12.08 as opposed to $27.73. So how do you know a Ferrari, a River Island dress, or a piece of steak is on sale? Well, the very answer is you are buying the very same product, but simply for a lower price. Is the stock the same? Well, not exactly, because a company is dynamic. It's always changing. The engine of a car won't change over a year, but the engine of a company certainly can. So it's imperative not just to buy a stock because it's at a lower price, but because it's at better value. Oscar Wilde had a very interesting statement. A cynic is a man who knows the price of everything and the value of nothing. And this really captures the essence of success in the stock market. It's not about the price of the stock, it's about how the price compares to the value of the stock. So instead of just going along with everybody else, jump ahead of them and realise this early. So how can you tell if a stock is at good value when the price falls? Because maybe the stock is falling because the value behind it is falling. Well, there are quantitative or numbers-based ways of valuing this. For example, by looking at the dividend yield, or the price to earnings ratio, or the price to cash flow ratio. Each of these I will be dealing with at a later stage in another video. But just remember, during the last class activity, which was introducing Wall Street right into your very own classroom, you bought and sold within minutes. But an investor buys and holds for the medium to long term, looking at months or years rather than minutes or days. And why is an investor willing to do that? Well, first and foremost, to avoid huge transaction costs. If you are buying a lot of stocks and selling a lot of stocks all the time, you will incur huge transaction costs, which will amount up and will significantly take a lot of your gains if you go about it the wrong way. And otherwise, an investor is willing to hold for the medium to long term to let the stock, i.e. the company underlying it, develop and increase in value, and hence then increase in price. If you think about it, if you're trying to make 1% every single day like a trader might, how can any given company expand 1% every single day? It would burn itself out within a matter of weeks. However, if you look at a company, it can expand maybe 10% every year, or maybe less, or maybe more, but it gives itself time to do so. And therefore, if the company is expanding and developing in value, well then, naturally, you will see an increase in price. So why aren't traders willing to do like investors? Well, in some cases it's a lack of awareness. Many amateur traders have no idea what they're doing, simply jump in and hope for the best. Other people have unrealistic expectations. They may have heard stories of stocks that jumped very far and very fast and think that happens all the time. It doesn't. Or else they neglect to take transaction costs into account. For example, let's say I buy a share today at €1 and I sell it tomorrow at 1.10. I've made 10 cents on it, or 10%. But what about if I'm actually I'm paying transaction costs of up to 5% on that if I'm starting with very small money? Well then, that significantly eats into my gains. Or maybe some people just want faster money. Unfortunately, for a lot of people, it's simply not there. And why? Well, for about 95% of people, they will try to outperform the market and may not even make the market return due to, as I said, first of all, the transaction costs, but second of all, because there are professional institutions out there who have information long before it ever gets on paper, never mind gets printed in the newspapers, and will make their money out of that before amateurs have a chance. So therefore, for about 5% of traders, this is a possibility, this faster and this better money. But for the vast majority, that is not the case. But you can still succeed. Because for somebody with much less time and knowledge, you have a much better chance of doing well as an investor, because new money is being created as the companies develop. Like what I said, the company who may expand it with 10% a year, but you're actually giving them a full year to do it. That is possible. And if you do choose the trader route, remember that the odds are stacked against you. Now bear in mind why the stock market exists at all. That was what I covered in the last video. It exists because companies are there to make money. There is no point setting up a business if you think it's simply going to make a loss. So by investing in a company, you are investing in what is trying to be a money-making venture itself. You're simply taking a part of the action, like I explained in McDonald's in the very first video. So the question you need to ask yourself, are you a speculator or are you an investor? Well, a speculator looks at short-term bets, trying to get in and out, and active buying and selling, doing it quite often. Now bear in mind, remember what I said about transaction costs. Every time you buy, every time you sell. And often speculators have an uncertain basis for buying and selling, just hoping to work on information that is very short-term and may work in their favour or not. Investing, on the other hand, is where you're looking at the medium to long term. You're giving companies actual time to develop. And also you're investing on the basis of company fundamentals, like the dividend yield and the price to earnings ratio, and numbers based ideas where you can compare one company to another, and it's very, very clear to see where the value is. And I will be covering that in another video in a very short time. Thank you very much. This is Susan Hayes, the Positive Economist, and we look forward to seeing you at the next video.